Hey everyone, welcome back. Today we're going to be talking about another tax strategy that is often overlooked, but could be super beneficial to your situation, especially for you retirees out there, and that's tax gain harvesting. If you watched the last video, I talked about tax loss harvesting. So if you haven't watched that, feel free to check that video out. But today we're going to be specifically focused on tax gain harvesting. So most people think tax gain harvesting is something that you should avoid entirely, but I'm going to show you how it can actually work in your advantage in retirement. So if you're looking to lower your future tax burden, stick around because I'll break it down for you with some real examples. So what exactly is tax gain harvesting? It's when you intentionally sell investments that have appreciated in value, realizing some of those gains to take advantage of a lower tax rate. So typically when you're in a lower tax bracket, or maybe during a year when you're not drawing much income. So this may sound counterintuitive since most of us try to avoid taxes on our gains, but in certain situations, this strategy can save you a lot of money in the long run. So here's the thing, retirees, and when you're retired, you often have a lower taxable income compared to your working years. And that could be a great opportunity to realize some gains at a lower tax rate that you might pay if you waited until later on in retirement when your income is much higher. So let me show you how this works with a specific example. Let's say you're someone who's retired or you're about to retire and you have a portfolio of stocks and bonds and you've seen some of your investments grow over the years. You're now in a lower tax bracket because you're not earning your typical salary. But let's pretend your portfolio has appreciated, 50,000-ish in gains. Well, if you're in the 0% long-term capital gains tax bracket, you could sell some of those gains and pay zero in taxes. That's right, zero in taxes on your $50,000 gain. Let me explain how this works. So the IRS has special tax rules for long-term capital gains. So if you're in the 0% long-term capital gains tax bracket, you don't pay any taxes on the gains from your assets you've held for more than a year. And depending on your income level, that's a sweet spot if you're retired or if you're getting close to it, because you might not have a large income from other sources like pensions or Social Security. So when you look at the tax brackets from a capital gains perspective, there's essentially three percentages that you have to think about. There's 0%, there's 15%, and 20%, which is the highest on a federal level that you'll pay in capital gains. So let's just say in 2025, the 0% capital gains rate tax rate applies if your total taxable income is below, I believe it's $89,250. You might want to double check that, but $89,250 for married couples or $44,625 for single filers. So that's a pretty nice window again for retirees, especially if your other income sources don't push you into that other higher tax bracket. Let's say you have $50,000 in capital gains. If you're under those thresholds, you could sell your appreciated assets and pay absolutely nothing in taxes on those gains. It's a perfect opportunity to take advantage of this tax-free window to help fund your retirement without paying Uncle Sam a dime. And I always say, if you don't have to leave Uncle Sam a tip, you don't have to. And it gets even better. So by strategically selling gains in these lower tax years, you can spread out your tax liability over time and avoid pushing yourself into higher tax brackets later. So this could be particularly useful for people if you're in your 60s and early 70s and when income might be low before you start drawing down your retirement accounts or taking Social Security. Another focus point is, what about the people that are in a higher tax bracket or nearing the top of that 0% capital gains threshold? Well, tax gain harvesting can still work for you, but the goal would be to avoid jumping into that next tax bracket. So instead of selling all your gains at once, you could just sell just enough to stay in your lower tax bracket, paying taxes at the most favorable rate possible. To give you some more context, or another example is, let's say that you're in the 15% capital gains tax bracket. Well, you might sell some of your appreciated assets, but limit it again to a specific dollar amount to avoid moving into that next 20% tax bracket. So it's all about staying strategic with your sales and knowing how much room you have within each bracket. So here's the bottom line. Tax gain harvesting is a super smart strategy for anyone that is in retirement, especially when you're in a low tax bracket or if you're planning ahead for your future tax situation. So by selling these appreciated assets during those years when your taxable income is low, you can minimize your tax liability and leave more money to enjoy in your retirement. Here's a quick, simple, step-by-step list. So first thing is you want to review your taxable income. So take a look at your expected income for the year and see if you fall into that 0 or 15% capital gains tax bracket. The next thing is sell your appreciated assets strategically. So if you're in a low tax bracket, sell some of your appreciated assets to take advantage of that tax-free or low tax rate. But you want to make sure that you keep track of how much you're selling, because you don't want to make sure you don't want to accidentally bump yourself into a higher tax bracket. Next thing is you want to plan ahead. So if you're not sure what your tax bracket will be in the future, talk to a tax professional, talk to a certified financial planner to help you plan out the best strategy for your situation. If you're not sure whether tax gain harvesting makes sense for you, or if you want help with your tax strategy, again, you can talk to someone like me, talk to a certified financial planner. Feel free to reach out to the website. Always happy to have a conversation to see if it's a good fit for you to do this type of strategy. So in closing, thanks so much for joining. Again, tax gain harvesting can be great strategy for you to reduce your tax bill in retirement. And it can be especially useful, as I mentioned, when you're in a lower tax bracket. So if you found this video helpful, make sure you hit that subscribe button. Thanks so much for joining me today, and I'll see you on the next video. Cheers.